All right, class, let's talk about what we're going to cover this time. We know last time we got our introduction to long-term assets and we learned 3 basic depreciation methods. This time we're going to learn about a very specific type of acquisition called a lump sum purchase or a lump sum acquisition. We'll go over several examples of how to handle these and we'll do a little homework preview for you. Next time we're going to go over revisions and disposals of long-term assets. That's next time. First of all, we've got to understand what these lump sum purchases are. I may abbreviate with this LSP term, but don't be shocked by that. That's what it stands for there. These lump sum purchases are when a company acquires 2 or more assets in one transaction for one price. Doesn't matter what they paid for it, whether money was borrowed or paid 100% cash, but when they get 2 or more assets for one price, we call it a lump sum purchase. Common example would be if a company buys a large building, whether it's an office building or a factory, whatever. They typically would buy the land, the building, and the furniture. Not always, but that's a real common lump sum purchase you're going to see. 3 different assets, land, building, furniture, and they have to be treated very differently for good reasons. These can also be called a group, a bulk, or a basket purchase, but most commonly they're called lump sum purchases. All right? Because there's one price in so many different types of assets, accountants have to be very careful about finding the appropriate value for each asset and recording it appropriately. Here's a common example. Let's suppose a local developer purchases a small apartment complex for $4 million and he's going to pay cash for that lump sum purchase. It includes land, buildings, parking lot, and equipment. So what does the accountant do here? How would you record this transaction? Well, it's rather simple as long as you understand it. How the cost is recorded on the books is in accordance to IRS code, which says that the individual costs of each asset have got to be recorded proportional to their relative value. Now, what does that mean? It means that you've got to take a look here at the total appraised value or assessed value of the assets. And even if the total assessed or appraised value adds up to more or less than the purchase price, you have to take that into account when you actually find the proportional cost of each asset. Now, what does that mean? Let's take a look at an example. Okay, you have to do it by fair market value. Well, what does fair market value mean? IRS says that that's a price that is changing hands between a willing seller, willing buyer. Nobody's under duress. They're not being forced to buy or sell. It's not a unique situation where it's a fire sale or something like that. And of course, both parties have good knowledge of all the facts pertinent to the situation. So that's how they define fair market value. Usually, though, this is done by a comparison of comparative properties. You might have heard this term in the real estate business known as comps. Got to find some comps for your house if they're going to appraise it. And it will often involve a formal appraisal. Not always, but it'll often have that formal appraisal. So the appraised value will typically be given to you in each of these situations. And so in this problem, the appraised value for this apartment purchase was as follows. Right? Notice the appraised value adds up to $5 million. Well, what was the purchase price? They only paid $4 million. So one thing we got to watch out for is that just because the appraisal comes at a certain amount doesn't mean that that's what they paid. These numbers can be different. In fact, in most cases, they are different. So what does your journal entry look like? Well, let's just put down the appraised values, right? There we go. Put down cash $5 million. No, we can't do that because we didn't pay $5 million. You have to be careful about recording costs that are no more than what you actually paid. If you got a scream and deal on this thing, you got to proportionally take these costs down, and that's what we're going to do here. Okay, the IRS code said you got to use fractions, same thing as proportions. So we're going to do this in 2 steps. First, let's find the percent of the total appraised value for each asset class, line item by line item. So let's do that. Here's where a spreadsheet comes in handy, and I just copied this from an Excel spreadsheet. The land was appraised at 2.5 mil, building at 1.5, parking lot half mil for the equipment as well. These add up to 5 million. Notice it's more than 4 million again, and you can see clearly 2.5 mil over 5, that's 50%. 1.5 mil over 5, 30%. And half mil divided by 5 mil is obviously 10%, 10% here. These have to add up to 100%, just like these numbers here have to add up to the total appraised value. You're not typically given this 5 million, you have to add that up. But clearly, these percentages need to add up. They have to add up to 100. Okay, now next step, you're going to multiply the percent for each asset by the actual total purchase price. So I simply take 50% times what? what did I actually pay? I paid the 4 million. So 50% of 4 million is going to be 2 million. 30% of 4 million is 1.2. 10% is 400K. 10% is 400K. And now, of course, these have to add up to 400K as well. Okay, so that's how you do it. Two simple steps. Find these ratios or percentages according to the appraised value, even if the total appraised value is different than the total value, the total cost that you paid. And then you have to use those percentages to allocate it out proportionally. Okay, so our journal entry is actually going to look like this, right? This has to be consistent with the cost we actually paid. These are proportional but smaller because we got a good deal. The appraiser said the whole package was worth 5 million. We paid 4 million. We got to take these down accordingly and proportionally so that it equals the actual price we paid. That's how we do it right. Okay, what's this look like? Here's a visual. If you take a look at the land, the blue slice of pie, notice it was 50%. It's half the pie, no matter how big the pie is. This pie totals 5 million. Smaller pie totals 4 million because that's what we actually paid. But the building is still a third. Notice that's about, well, actually it's 30%, not quite a third, but that's about 30% of the pie. Same thing here. Parking lot and equipment, these are each 10% of the pie. And so you can see that those are proportional as well. Even though the whole pie is smaller over here, the slices are proportional. Okay, hope that makes sense. Hope that visual helps. And clearly, we've done this properly if the slices of pie are in the same ratio, the same percentage, or the same fraction as they were with the total appraised value. Okay, it's your turn now. Let's suppose Facebook wants to buy an office, and they buy the old Roseville Gateway campus. $8 million is the price. To close the deal, they had everything appraised, and here's the appraisal values. 5 mil, 3 mil, 2 mil, nice easy numbers. Your job, find the appropriate cost. That should be recorded in the company's books for each asset for this transaction. Okay, I want you to pause the video now and go work it out real quick before you click forward to the next slide. It should only take you a minute, but pause the video and then come back when your calculations are done. Okay, did you unpause the video? Hope you're back. Now let's take a look at this. All right, the solution would be find the appraised values, use the appraised values to find relative percent for each asset. So 5 million divided by 10, they added up to 10, you got to see that, is 50%. This is 30%. Oh, these proportions look familiar. This one is 20%. I've given you very nice round numbers here. We know the total is 10 million, and so 5 divided by 10, 50, and so on and so forth. Now down here, we actually paid, or Facebook actually paid 8 million, so they take that 50% times 8, you get 4 mil. 30% times 8, you get 2.4 mil, and so on. And of course, these three numbers here have to add up to 8 million, and they do. And that's the actual purchase price. So pretty smooth. And this is how you would record it on the books, at these values here in the orange font, not in the yellow font there. Okay, I hope that's pretty straightforward. Now, why does this matter to you? If you were to buy property, if it was investment property, you might be able to depreciate the structure, but not the land. So your property tax bill breaks down the value of the land and the building, and actually it looks like the land is worth more in this case here. I've blacked out the owner's name and everything here, but you can see that if the land, or structural improvements as they call it, if this was worth more, the owner here would be able to take more depreciation, and that's a very real tax deduction. It's not cash, doesn't cost him anything, but he gets to write down that depreciation, typically over almost a 30-year lifetime. Okay, and we'll talk about timelines for depreciation later, but even the county office here, the county tax assessor, she breaks this down into proportions, so you can't depreciate the land, you can depreciate your building. Okay, so here's where we're going with this. By next class meeting, you're going to complete this worksheet that is attached, or if you're in class, I'm going to hand it out to you in class. Notice on the back of the back page, there's an answer box. All the answers you need should be found there, and there may be some extra ones that you don't use, just to try to keep it straightforward. You're going to have to do the week 6 homework on the Connect site. You get 3 attempts, 20 points total. That's due by Monday night, as usual. Okay, and then if you want some extra help, this whole video is viewable right here on YouTube. So you're already watching it if you're watching this video, so that's a moot point. And there it is. Hope that helps you. There's some other resources here from other universities. I think this one here is from Utah State, and they have a very good explanation of lump sum if you prefer to see somebody else explain it. Okay, there you go. That's the end of our show, and hope that helps you. Feel free to play this lecture again if it helps.